Good afternoon, everybody. I'm Glenn Dial with American Century, and today we're here to talk about the Target Date Blueprint. And you might be thinking, well, what is the Target Date Blueprint? And is that another Target Date tool? And why do we need another Target Date tool? So let me start with a little bit of the inspiration behind why we developed the tool. And by the way, it just came out a few months ago. Brand new, and it is a very different take on what you've seen out there so far. Part of the inspiration of the tool is I was at a conference similar to this one. It was pre-COVID, so I was able to attend the session in person. And during this particular session, there were the three, call it the talking head ERISA attorneys on stage, and they were talking about what was going on in the industry and litigation. And they talked about, how much, there's been all this litigation around fees. And we all know that, right? We keep hearing about fees, and more fees. But somebody in the audience asked the question, and the question was something like this: hey, what's the next shoe to drop in our industry in terms of litigation? And all three attorneys agreed on this. They all said that they thought it was going to be around target date suitability. And they all said that the next round of lawsuits would probably occur when we see the next prolonged market downturn. So, it doesn't need to be as bad as 2008, but when we see, call it a down year. So I was a little surprised when I saw this lawsuit hit last year, which was filed against Walgreens for $300 million around target date mismanagement or performance. Now, the reason I was surprised, and I think a lot of industry insiders were surprised, is that this happened during a 10-year bull market, meaning that most target date performance, whether it's your best performer to your worst performer, were very similar. There wasn't a lot of differences in the performance. Now, during a down market, we see the differences being much, much greater. So again, we think this is a sign, unfortunately, of times to come if we see a downturn in the market that lasts for a significant period. So I like to start with talking a little bit about the evolution of our industry. I mean, when we take a step back, our industry is only 39 years old since the first 401k plan actually went live. So we're young. The first 401k plan only came out in 1993. And the reason I bring this up is back in the 80s and early 90s, we were very much of a supplemental savings plan industry, not a, call it, full-time retirement plan industry. In 2006, when we got the Pension Protection Act, think of that as the government or the Department of Labor really coming out and saying, hey, you really, really need to start, making 401k plans or 457s or 403bs look more like retirement plans versus supplemental savings plans. When that came out, unfortunately, right afterwards, we had the financial crisis. Then we got the DOL tips, which we're going to talk about a little bit later on, which really helped address some of the shortcomings of target date funds because of the financial crisis. And then last year in December, we had the Secure Act, which was really more around, one of the big, reveals there was guaranteed income. And the government really wants us to look at that a lot harder going forward. Now, this chart is no big surprise to folks. It's just saying that DC plans have really taken over DB plans as the primary source for most workers in terms of what their retirement plan is. When we do look at QDIAs within a DC plan, and we go back to some of the original guidance that was given to us back in January of 2008, the Department of Labor, I think, was careful not to come out and give asset managers like us exact advice on how to do our job. But they did say, hey, you know what? A QDIA or a target date fund cannot be 100% stocks, nor can it be 100% bonds. but it must be diversified as to minimize the risk of large losses. Now, this language came out in January of 08. No sooner than the ink was dry on the final QDIA guidance did we have the 08 event happen. And we saw that most, and this chart here shows on the left-hand side where it says aggressive down 36.6%. What that means, these are your 2010 target date funds, meaning these are your 60 to 65-year-olds. Most of the 2010 funds were managed in this aggressive manner, meaning that most folks in target date funds that were just defaulted, a few months earlier, lost over 36% of their lifetime savings. And contrary to popular belief, when you are between 60 and 65, you're no longer risk adverse. You're hyper risk adverse. And this chart shows that age segment did in fact panic and did in fact sell out and lock in those losses forever. So it's very, very important to think about that and keep that in mind, especially today as we go forward. Depending on who you believed, and you look at the headlines that came out back then, they weren't good when it comes to target date funds. Financial Times, May 3rd, 2009, suitability of target date funds in doubt. Fortune magazine, April 27th, 2009, target funds missed the mark. It was the first time ever that both the SEC and the DOL held joint hearings examining target date funds. So it was not a good time to be in the target date business. And depending who you believed, you thought that target date funds were either mislabeled or grossly mismanaged. But we were fairly well convinced that they were taking way too much risk and that there was going to be some significant changes occur via the SEC and DOL. Now, as we all know, what happened after this financial crisis? Well, we've been in a 10-year bull market. Obviously, we had a little hiccup at the beginning of this, in March of this year, but now we're right back to all-time highs again almost. So when we look at, well, what exactly did it happen after 08? Well, the SEC actually came out last year and they dropped the target date marketing rules from the agenda. So net, no new action from the SEC, but we did have some action from the Department of Labor in 2013. So we got what's called the Target Date Retirement Funds Tips for ERISA Plan Fiduciaries. And the way I think about the tips is this is the Department of Labor coming out and saying, all right, we've got to, we've got to take into account more than just performance and fees. Now, performance and fees are still very important. Don't get me wrong, but we have to look at more than just that, right? We can't just look at performance and fees when we're picking target date funds. So think of it this way: we developed a tool. It's called the Target Date Blueprint. Step one in that tool is to align the characteristics of the employees to the characteristics of the target date funds. So I have a son that just started college this year, and we were out shopping for cars. Now, when you're shopping for a car, whether you're doing it for yourself or a family member or whatnot, the first thing you really need to do is determine what kind of car do you want to buy. In other words, I wouldn't go to a car lot, either with myself or with my son, and say, hey, you know what? Let's look at the best sports car and compare that to the best Jeep or the best SUV and pick the best one from those two. We won't compare those two side by side. No, and what you're going to do first is decide what type of car do you want. Do you want a sports car? Do you want an SUV? Do you want a sedan? Do you want a minivan? What do you want? So once you narrow down the type of car you want, and let's just say it's an SUV, then you start going out and comparing, SUV, maybe you look at Ford's SUV and you compare that to Chevy's SUV and you try and pick the best one based on performance and price, right? I wouldn't go out again and say, okay, I want to look at Ford's SUV versus Chevy's sports car and then pick the best one. That would make no sense. But believe it or not, that's how we pick target date funds. We typically will compare an SUV to a sports car and then try and pick the best one. So step one in our tool, for lack of a better word, it's just aligning the characteristics, making sure you're comparing apples and apples. Then step two, just like buying a car, then look at price, then look at performance, and then look at some more risk features and safety features, right? And then step three of our tool helps you document and verify that process and that all required activities are performed. By performing this three-step process, you're basically helping to ensure that you're maintaining the safe harbor status of your target date funds, which is obviously very important, especially if there should be litigation. So that's what the tool is all about that we're going to talk about. Now, when we say, well, what exactly do the Department of Labor tips, what are they calling out? And especially when we say characteristics, what do we mean by characteristics that we need to take into account? Well, on the participant side, we need to document the average age of the participant, the expected retirement date, whether they're covered by a defined benefit plan or not, their average salary level, their average turnover rates, the average contribution rates, including match. What kind of withdrawal patterns do they have at retirement? Are they taking lump sums? Or are they taking a systematic withdrawal? What are they doing? And what's their behavior, especially in a down market, especially for those near retirement? In terms of the target date characteristics that we need to look at, it's looking at the investment strategy or the objective of the target date fund. How much risk is it taking? What kind of glide path is it? Is it a steep glide path or a flat glide path? Is it a to fund? Is it a through fund? What are the underlying income assumptions of the target date fund, if any? And what's the underlying asset allocation? So we basically want to take these characteristics between the two, the participant and the target date fund, match them up, and do that screening first, right? So what our tool does, it literally has 3 sections comprised of 19 questions. So 3 sections, 19 questions. And in the 3 sections, the first one has to do with the review process, the second one with the employee characteristics, the last one around the target date characteristics. And what I'm going to do is I have this pre-filled out, but what I'm going to do is kind of walk you through at a very high level how the tool works, and then show you how to access it at the end. But at a high level, the first question around the tool is this a new target date fund, or are you doing the review process? Now, what you should know is that the Department of Labor says that the plan fiduciaries are required to periodically review the plan's investment options. So not that you should, but you're required to. The only question or discrepancy, or not discrepancy, but the variability that you have is how often. They said periodic. Well, what does that mean? Is that every year? Is it every 3 years? Is it every 5 years? They didn't come out and say, but I can tell you from talking to a lot of advisors like yourself, it seems like the most common answer is every 3 years, but I've seen many do it every year, and some do it every 5 years. So I would just say pick a standard time frame and just stick to it. And at a minimum, the review process should examine whether there have been any significant changes. And you might say, well, significant changes in what? So let's just look at that. Well, what do they want us to look at? They want us to look at, has the target date fund investment strategy, for instance, changed significantly in the past year? So this strategy, well, what could the strategy be? Well, the way I pre-filled this one out, we give you drop downs in the tool, but when the drop down says glide path change, so for example purposes only, I'm going to go ahead and highlight the glide path change. Say yes, there was a change. It was a glide path. On the other few questions, I'm going to say there haven't been any changes. So in terms of the management team, on question 3, I'm going to say nope, the management team has not changed. In terms of question number 4, is the fund's manager effectively carrying out the fund's stated investment strategy? I'm going to say yes, they're doing what they said they were going to do. In terms of question number 5, has your plan's objective in offering the target date fund changed? I'm going to say no, but the objective could be maybe when I selected the target date fund 10 years ago, my objective was to have the highest performing fund. Now my objective is to mitigate risk. All right. The reason I offered a change, probably need to go back and do a deeper dive review. Question number 6. Have the participants' savings rates changed significantly? We're going to say no, but believe it or not, savings rates are probably and arguably one of the most significant factors that determine how aggressive your target date fund should be. And we're going to talk about that in a few minutes too. And then the last question on the review is, have you started or terminated a DB plan? Again, we're going to say neither. So we only selected one change, okay? And just a reminder, we did put a summary of the tip at the beginning of each questions. So as I go to the next section, which is the employee characteristics, again, you're going to see a summary of the tips at the top. And then on the questions that relate to the demographics, I'm going to answer them in a format that gives me a more aggressive output in terms of what type of target date fund would be more of a fit or more suitable for this particular plan sponsor. So in terms of the questions, on question 8, the ages, I'm going to say everybody's young. They're less than 35 years old. On question 9, I'm going to say they also have most of the money. On question 10, I'm going to say that most folks plan on retiring early. Again, these are all considered aggressive type demographics. And believe it or not, an aggressive demographic is if you're covered by a traditional defined benefit plan. I'm going to say yes. Now, the reason I get some questions on this one, some folks will say, "Hey, Glenn, why if I have a DB plan, is my 401k or target date fund, why is it allowing me to be more aggressive?" Well, the reason is if between your DB plan and Social Security, if together they cover a significant portion of your retirement income needs, then you can view your 401k plan as more of a supplemental savings plan, which by definition, you can take a little more risk. Question number 12, earnings. The lower the earnings, the more aggressive you can be in your target date fund. The higher you make, the more conservative you should be. I get a lot of questions on this too. Well, why is that? It seems like someone that doesn't make a lot needs to be more conservative. Well, it goes back to Social Security and the fact that the lower income you have, the greater percent of your ending salary Social Security will replace. So there's a less of a gap that you need to make up. So you don't need to be as aggressive, if you will, if you're in the lowest income category. Again, these are general rules of thumb. The question 13, the turnover rate. This is the only one where I decided not to take the aggressive answer. I went with the median here, which is 10 to 20%. Just went down the line on this particular one. Question 14, what's the average contribution rate? I'm going to say 5% or less. And again, that's an aggressive answer. And now I get a lot of pushback on this question. Folks really come at me hard, and a lot of industry professionals debate this. And let me start by saying they're both right. It's a matter of interpretation, and matter how the mathematicians look at it and the actuaries look at it. So the way a typical actuary might look at this is saying, listen, if someone's not saving enough money, then they need to, quote unquote, invest their way out of their poor savings habits and try to give them any shot at all in terms of hitting their goals for retirement. Now, do I agree with that personally? I don't know. But that's how the math is going to work, meaning that the lower you save, the more aggressive you're supposed to be. The higher you save, the more conservative you can be. So for example, if you've done a great job, let's say maybe doing enrollment meetings or auto enroll and auto increase, and you've gotten savings rates up at your client, well, you probably need to go back and review your target date funds to make sure that they are still appropriate for that new savings rate. Question 15, what do the majority participants do with their plan assets after their retirement date. This one doesn't have to do with being aggressive necessarily, but we're going to just go with take the lump sum withdrawal, IRA rollover. So this is more about behavior. Another answer could have been periodic withdrawals. And we also added the annuity option due to the passage of the Secure Act last year. We think this might be something in the future that folks use. But again, we went with the IRA rollover as the answer. The last set of questions have to do with the target date characteristics. So we start out with the objective of the plan. Again, in the spirit of going with the more aggressive answer, we said that it seeks to provide participants greater long-term return potential by accepting greater volatility. Obviously, that's an aggressive answer. Question 17, how important is it for the target date strategy to serve as an income solution for retirees remaining in the plan? We're going to say it's not important. Question 18, here you have a little flexibility in terms of, I'm going to call this the catch-all category. What does the majority of plan participants' level of total savings suggest for the target date strategy? You might say, well, total savings, what are we talking about? Generally speaking, this is kind of your and the plan sponsor's opportunity to have some input on the target date fund. Hey, do you want one that puts more emphasis on capital growth or more emphasis on capital preservation or balance? Now, the rule of thumb is the more outside savings that you have, and that means the less dependent you are on the 401k, that maybe you interpret that as being, all right, I can put more emphasis on capital growth. Or or you might interpret that exactly the opposite way. Maybe you say, you know what, I don't have, I'm fully dependent on my 401k. It is my only source of retirement income. I've done a good job of savings. Therefore, I'm going to put more emphasis on capital preservation. So again, there's a little room for interpretation here, but again, it's what I call the catch-all type question. 19, which statement best describes the likely change in behavior for an employee nearing retirement following a stock market decline of 20% or more? We're going to say a behavior I wish I would have done, which is on March 23rd of this year, which is an increase in participants moving to higher equity allocations to capture the market recovery. It seems like we can never kind of catch that bottom, but obviously that would be considered an aggressive type behavior. Other behaviors are, well, do I maintain, do I stay the same, or do I sell? Lastly, the Department of Labor does ask on these tips to take advantage of commercially available resources. So we're going to pre-fill out targeted blueprint for you, but maybe you use FI 360 or other programs. You would just list those in here. Now, what is this? This is the first page of the output, which is, it gives us a very high level overview of the type of targeted fund that we're looking for. So we're looking for, and we're looking at 4 major risk metrics. We're looking for a target date fund that does a really good job of mitigating growth risk. Hopefully you can see that little bubble there, and that aligns with most important risks. So we're looking for a target date fund that does a good job of mitigating growth risk. And what's less important is mitigating market risk, macro scenario, and income horizon. Now, again, that's because of the way I answered the questions. I kind of, for lack of a better word, I tricked the tool into giving me this kind of profile. So I'm looking for an aggressive profile target date fund. So when I go to the next page, you should see target date funds ranked by quartile, with the most aggressive being in the first quartile. And that's what you see. So if you look at quartile 1, which say most suitable, quartile 4 is less suitable, you'll see funds like T. Rowe Price and Fidelity and American Funds and Vanguard being recommended as, or I should say recommended, but directionally speaking, look more suitable or better fit, right, than and target date funds call it in the fourth quarter. Now, this is directionally speaking, right? And this goes back to my car example where we said that, hey, you know what? Figure out what type of car you want to buy first, or do you want to buy an SUV or a sports car? So maybe these are sports cars and your SUVs are here and your sedans are here. Think of it that way. This is the first step in terms of determining what type of target date fund is more appropriate. The next, again, you can, by the way, you can select up to 6 for comparison purposes. I selected 4, I pre-selected these 4. And when I go to the next slide, you can see the comparison of these 4. What we're doing here is showing the entire glide path for all 4. And you can see the glide paths are very similar because these are your more aggressive type target date funds. On the live tool, and again, this is just a screenshot, but on the live tool, you can toggle over any time frame and see what the underlying equity percent is. Now, I left it on at retirement date, so if it's 65, whatever, but whatever the expected retirement date is. You can see at T. Rowe Price has 57% equity, Fidelity 51, American Funds 48, Vanguard 51. So again, this is part of the output and part of what the DOL wants you to look at in terms of equity allocation, to versus through, how much risk is taking, things like that. And on the report itself, you can upload your logo, the plan sponsor's logo. You can put in additional notes, which, by the way, this gives you quite a bit of flexibility. You can either cut and paste or enter up to a page worth of notes. And then you actually get the printout of the tool itself. So you get the cover page, table of contents, an overview again of the risk profile. Then you get your quartile rankings. And let me stop here for just a second and tell you a little bit about what goes in those quartile rankings. So the math behind this is quite extensive. While this looks pretty straightforward, just quartile 1 through quartile 4, what we're looking at is the entire glide path for each one of these target date funds, and running that glide path through our forward-looking capital markets assumptions, running a Monte Carlo simulation through 400,000 different economic scenarios. Once we have that scored out, then we weight it based on how you answer the questionnaire. So the math behind it is quite extensive. We're not just looking at 2 points in time, if you will, or 2 data points. We're looking at an entire glide path through entire market, 400,000 entire market cycle. So very, very extensive evaluation. Now, the second part of it, I would say, is equally as important, the documentation side. So what we do is we go through, and the plan sponsors really, really like this report, because what we do is show them the entire tip at the top of each page that deals with it. So this tip, again, deals with the review process. The Department of Labor says, hey, you need to do the review. Here's all the stuff you need to look at. And then at the bottom, here's how you answer the question. So remember that first question we said the target date investment strategy has changed significantly. Therefore, it may be necessary to consider replacing the fund. Because again, we said the glide path changed. Now, we've gotten some pushback on this. Hey, Glenn, that sounds like some pretty harsh language. Why? What do you mean? Why are you putting in there it may be necessary to consider replacing the fund? Well, it's not our language. If you look right above it, I know this looks a little blurry, but if you look right above it, you can see that language comes right from the Department of Labor tip verbatim. So that's really the Department of Labor's tip. But it does, again, it fulfills that documentation, and think of this as the red flag call out. The next tip has to do with the employee characteristics. So again, we list the entire tip at the top, and then how you answer all the questions at the bottom. Remember, we said that these employees were under 35 years old. They had most of the money. They want to retire early. They're covered by a DB plan. We said they're low salary level, median turnover, contribution rates, and what they do at retirement, in this case, take a lump sum. So boom, there's your documentation. Here's what the DOL says you have to do. Here's your documentation. Same thing with the target date characteristics, we list the entire tip at the top, and then how you answered all those questions at the bottom. And again, this takes about 2 pages because it does want you to look at the glide paths to determine if it's to or through. Visually looking at these, all of these look like they go right through retirement date. So these all look like through funds, just from a visual representation standpoint. The next tip has to do with fees. There's an entire tip devoted to it. What we do is, oops, sorry about that. What we do here is this tool is really meant, the TargetDate Blueprint, when I say this tool, the TargetDate Blueprint is really meant to complement your existing tools that evaluate fees and performance, and even to a certain extent risk. So we're really saying that you're going to, that fees, expenses, and risk performance have been or will be evaluated prior to final selection. Because remember, this is really about figuring out apples to apples. Once you have that figured out and documented, then do your normal analysis and use whatever tools that you use today to do the side-by-side comparison for performance and fees, and even additional risk metrics. The next tip, I get a lot of pushback on this one too. Inquire about whether custom or non-proprietary targeted funds would be a better fit. So what we did is we pre-populated this with a standard answer and said prepackaged products from the vendor, as well as custom and or non-proprietary targeted funds have been considered. Again, we have that notes section. So if you want to expound upon that, you can add that to the notes section. Employee communications. This is a pretty, this tip looks like it's pretty daunting, but really all it says is that both general and specific target date fund information will be shared with the appropriate employees, and when appropriate, the advisor will work with the record keeper to provide this information, and you'll check back on their website for updates. So pretty standard stuff. So either you're going to do it or you're going to partner with the record keeper to do it. The next tip does say to take advantage of available sources of information. So again, we pre-populated TargetDate Blueprint and we added FI 360. But again, if you're using other proprietary tools or whatnot, just make sure those are listed. And here's again, I just wrote in unlimited words, but you can put as many comments as you want. This is how you kind of make it your own. And then of course, the DOL says to document the selection and review process. So you want to make sure you do that and sign and date it, advisor, the plan sponsor, plan administrator, plan fiduciary. So what we've done is we've got a lot of math behind how do you compare apples and apples, if you will, for the determining best fit or more suitable type funds, and then you documented your decision process. We do give you a methodology. So when I talked, I know I went through it pretty quick, but when I talked about growth risk and market and macro and income horizon, if you want to know, well, what does that all mean? Here's all the definitions. We do, in some cases, we have multiple kind of definitions or data points that we're looking at. So for macro scenario, for instance, we're looking at interest rate, inflation, currency. Market risk, we're looking at long run volatility, sequence of returns, max drawdown over 3 years. So you can so just make sure you get familiar with the definitions. We do give you some more input about how to interpret the questions. I know again I went through those quickly, but you can come back and look at this and see how we interpret them. And I would highly recommend on the kind of the last page of the report is to make sure you go back and look at how did we come up with that suitability score. And then on these 4 funds, this tells you. So in other words, you get the total suitability ranking on the far right-hand side, meaning we said all 4 of these funds were suitable or a good fit. But then you see, how did we get there? You see that based on how we filled out that questionnaire, that growth risk got a whopping 70% weighting. Market risk only got a 23% weighting. Macro scenario got 6%, income only 1. Also not surprising, and by the way, low score is good. Not surprising is all the funds that ended up being suitable were all the ones that scored really well in mitigating growth risk, right? They all had low scores, dark green here. The reason I think it's so important to look at this scoring is what if growth in market had about the same percent weighting. And the overall scores came out similar, but they got there in very different ways. So it's very important to come back and look at this sheet and potentially eliminate other funds that might not be a good fit because they got to the right place but in the wrong way, if you will. So it really does pay to kind of come back and look at this page. So when you and of course the obligatory compliance notes on the end notes, and of course if you'd like more information or you want to get you get access to this tool, call our sales desk at 800-345-6488 or visit americancentury.com/iPro to go to the tool. But I would leave you with the feedback that we're getting so far has really been incredible. We did hire Brad Campbell, and you may know him. He used to work with the Department of Labor. He's the guy who signed the final QDIA regulations. We did work with him on the creation of this tool. And luckily, we have a white paper coming out from him at the end of this week. So you can get a copy of the white paper that goes along and complements this tool and kind of gives a legal background on the tool. But again, the big takeaways are the target date ranking. This is really more from a comparing apples to apples, and then the documentation. Okay, those are the big two takeaways for the tool. I'd recommend supplementing this tool and using it in conjunction with other tools that you might be using. And again, feel free to reach out to your American Century retirement consultant or specialist to find out more information about how to use the Target Date Blueprint tool. Again, thank you for joining American Century Investments. Have a wonderful rest of the conference, and stay safe and be well. Thanks again.